Hi, this is Steven Quach with Keller Realty, and I'm here with Perry uh, Ghilarducci. Did I say that right?
You did. Ghilarducci.
And Perry is with Avaunt Ltd. Is that correct?
Yes.
And he's my CPA, and he's a CPA for many out there. And we are talking about gift and estate taxes, real estate taxes, capital gains taxes, and tax write-offs for buyers, sellers, and homeowners. So for topic number one, the gift and estate taxes. From time to time, our clients will receive gifted money from family members during the purchase of their home. Can you explain what the standard gift tax is and why this may be a concern to family members?
Sure. When people give money to other people, so when there's a gift that's made for whatever purpose, it could have tax consequences, but most often it doesn't. And what I mean by that is if you would give a large amount of money over what's sometimes referred to as the annual excluded amount of right now $14,000 in 2016, then that amount that goes over that limit is referred to as an excess gift. And so that's the amount of money that may or may not be taxable either now or in the future. So an amount of $14,000 can be given from anyone to anyone in a single calendar year.
Okay.
Without any reporting.
Okay.
So think of like a Christmas gift or a birthday gift. Obviously, we're not keeping track of those amounts, but if someone's got a lot of money to give, there's a limit, so to speak, of $14,000. Doesn't mean you can't give more, but it just means that if you give that amount or less, that it's not reportable anywhere.
A lot of times the amounts are going to exceed $14,000, and they could range from anywhere from 50,000 to 100,000 plus. Is there a way to avoid the gift tax?
What happens there is that once the excess gift is calculated, then let's say in your example you said 50,000, that would be $36,000 over the limit. So what happens to that $36,000? That would be an amount that is not currently taxable, but the way that that's kept track of is that you file a return, a gift tax return, and that excess gift amount is subtracted from that individual's lifetime limit of taxation. So in other words, the gift tax is tied to what we refer to as the estate tax. You subtract that gift from your overall lifetime limit, which is a huge number. Currently, that's $5,450,000.
Right.
So for most people, no big deal, right? You take the excess gift, you subtract it from that upper limit of $5,450,000, and so now you have something less than that to give away or to pass on to your heirs after you decease.
Gotcha. So each individual can gift more than $14,000 per year, or for that year, and have it applied to the estate taxes, which is roughly $5 million at this point for each person.
Correct. Yes, for each person. So there might be a situation where, like, say you're married and you and your wife give your son or daughter up to $28,000. So it's applied on an individual basis. And a lot of people don't know is you're actually supposed to file a gift tax return to report that gift, even though there's no taxes that are due on that gift, assuming you haven't exceeded your $5 million.
There is a form that needs to be completed for the estate so that it records the balance.
That's right. It's IRS Form 709.
So I guess estate planning would then, if somebody is giving more than $5 million to their family member, then that's a whole nother story.
Yes. Yeah, there would be reason why you would want to gift if you're extremely wealthy. You can get that asset out of your estate so that at an earlier date, so that you avoid keeping the appreciation of that asset in your estate. So cash is not going to appreciate, but let's say real estate or stock or something like that, some people will give that asset so that they can get it out of their estate so that they can manage that lifetime excludable amount.
Gotcha. And is there anything else that would benefit the donor for gift taxes? Is there anything that they should watch out for?
No, not for property. There are a couple of exceptions to the gift tax. One is if you give, and actually if you pay for someone's tuition, or if you pay for someone's medical expenses, if you pay those expenses directly without going through the individual, so let's say you pay the college or you pay the doctor, then that doesn't count towards your $14,000 limit.
Oh, cool.
So there are other ways that you can help people, and not have to be required to file a gift tax return.
Awesome. Okay, it sounds pretty simple. And so I guess going to our next topic, home sales, capital gains taxes. So can you explain to me what capital gains tax is for when you're selling a property?
Sure. The capital gains tax is a tax that an individual pays on property that they've held and that property has gone up in value. So the capital gains is the difference between what you sell the property for minus any closing costs and compared to what you paid for that property. So the gain is referred to as a capital gain.
Okay, and then you can write off the closing costs as well.
The closing costs reduce the amount of the gain. That's correct.
Okay. Actually, I'm going to come back to that in our third topic on tax write-offs. How much is the capital gains taxes, and how much can you exclude capital gains taxes?
Sure. There has to be a distinction made first between whether the property that you sold is what's referred to as your principal or primary residence,
okay,
versus another type of property, which could be your investment property, or even what's referred to as a second home, a vacation home, for example.
okay.
So there are benefits to selling your primary residence that are not given to people that sell those other types of properties.
Okay, so for second home and vacation homes and investment properties, there's no exclusion.
There is no exclusion. There is a method of avoiding tax on the capital gains, but that involves typically exchanging that property for another property, taking advantage of another section of the code we refer to as Section 1031,
okay,
or what's referred to commonly as a like-kind exchange. Essentially, continuing your investment in the investment property into a new property without necessarily taking money out.
And so is there an exclusion amount for principal residences, primary residence?
There is. It depends on whether the individual is single or married. For a single taxpayer, that excluded amount is $250,000 of gains.
okay.
The married couple filing a joint return gets a $500,000 gain exclusion.
Okay. And so for the investment properties and the second vacation or a second home and a vacation home, is there a way to exclude the capital gains other than with the 1031 exchange?
No, there isn't. That's a taxable event.
Okay. If the owner lives in the property for like in the investment property or second home or vacation home for 2 years, are they able to exclude or consider it a primary residence?
They can. There is potentially some depreciation recapture. So let me back up. So an individual that moves back into one of those investment properties or vacation homes and makes that their primary residence and then sell down the road, as long as they've owned and occupied it as their primary residence for at least 2 of the last 5 years from the date of sale. So if you look back 5 years and can say you lived there as your primary for 2 years at least, and of course you've owned it for that period of time, then you can reestablish that as your primary residence. However, the benefit of the exclusion or the gain exclusion we just talked about a minute ago, that's limited because you will in fact have to pay taxes on any depreciation that you've previously taken on the property. So it's not a full exclusion, but it nevertheless, it is available to people if they're willing to move back into those or move into those properties and live there the required period of time. The depreciation is recaptured, and they get essentially a what we might call a partial exclusion. So you can do that if you're able to meet the ownership and occupancy tests that we mentioned, the 2 of the last 5 years.
Okay, so it's a partial exclusion. You're not going to get the full exclusion, but you have to backtrack a little bit.
Right. There are some cases where people will be forced to move, loss of a job, a change in marital status. There would be some, what the code refers to as unforeseen circumstances.
Mm-hmm.
So let's say you can't stay there for 2 years. Say you have to take a new job in another city and you need to sell the house and move on. You would get a prorated exclusion, assuming you met one of the unforeseen circumstances, you qualified under that definition. Then let's say you could only live in the home for a year out of 2 years. So if you could only stay there a year as your primary, then you would get half of the allowable exclusion available to you. So there is a little bit of relief or potential relief if you have to sell for, again, what's called unforeseen circumstances.
Gotcha. Okay.
So that's something to look at. That's described in IRS Publication 523, which is kind of supposed to be the English language version of all of these rules.
And that's something that you can calculate when you're working with your clients, correct?
That's right.
Okay, perfect. And so I guess we're going to wrap this up with the tax write-offs when buying and selling real estate. Is there any tax write-offs, I guess, when buying, selling, or owning real estate that people should be aware of that they can claim or that we should be holding on to as soon as we purchase or sell the property, that keeps everything organized and so when it comes to tax time, they can provide all that information to their CPA?
Well, you said the magic word, stay organized, and so it would begin with setting up a file with that very first document, the HUD-1 or the closing statement on the purchase of your home.
Okay.
That will list the purchase price and any additional costs that you incurred when purchasing the home. And we have our clients bring that to their tax appointment so that we could study that document and see if there are any deductions sort of buried in the closing costs. One common deduction is sometimes individuals will pay points to receive a more favorable interest rate, and those points are what we call prepaid interest, and so that is a tax deductible item. If an individual itemizes their deductions and they purchase a primary residence, they can deduct those points in the year they purchase
Is there anything else that would be deductible for buyers? Inspections, are inspections deductible? How does that work?
Really, there are very limited deductions available. It essentially boils down to interest and taxes and mortgage insurance. So what we're looking at is we're looking at the closing statement. Sometimes those costs will appear on the tax documents that the mortgage company sends you at the end of the year. But sometimes we have to go to the closing documents to find that information. Property taxes, say you buy the home on, let's say today. The person who owned the home before has already paid the taxes for the first half of the year. You need to pay your taxes, your property taxes from the close of escrow till the next property tax bill is due. And so they'll charge you those taxes in escrow. And the only place we can typically find that amount is on the closing statement.
So are property taxes deductible from the income taxes?
Yes. Mortgage interest and property taxes are your two major home deductions.
What about mortgage insurance?
Mortgage insurance can also be tax deductible. There are some particular rules on that, but essentially it comes off in the mortgage interest section of your itemized deductions.
And what about insurance?
Insurance is not tax deductible. It would be on a rental property. So if you're not talking about your primary residence, but you're talking about an investment rental property, then you would want to deduct the insurance. That is a deductible operating expense of the rental.
Okay, so mostly all of the deductible interest or all the deductions for buyers are really kind of post escrow. So after the home has been purchased, so if you're paying property taxes, paying insurance, for example, nothing during inspections are tax deductible. Is that correct?
That's correct. Normally speaking, what we're doing is we're staying organized. We're keeping track of, if it's our primary residence, we're keeping track of our upgrades and improvements.
Okay.
And because those can be written off when you sell the property. Those are additions, what we call additions to basis, that get to be deducted when you sell, so it lowers the gain in the future. But they're not currently deductible, so you've got to save those records and receipts of those home improvements, not something like painting or something that's cosmetic or in the nature of a repair, but something that would be considered an upgrade or an improvement.
Okay, so like a new kitchen, new bathrooms.
Correct, landscaping, new roof, things like that. Yes.
I guess that leads us to selling write-offs for sellers. So what else can they write off when selling their property?
So we talked about additions like a kitchen, bedroom, bathroom, maybe a deck in the backyard. Let's say someone might build on a porch or at a patio. It takes you sort of outside of the lawn and grounds. You have landscaping, fencing, think of a swimming pool. Those are all, capital improvements. Even within the home itself, I know we increased our insulation in the attic. We were having really high utility bills, and we discovered we didn't have, adequate insulation in the attic. So insulation could be, a lot of people replace their heating and air conditioning systems, that sort of thing, and even gets into upgrading new appliances, carpeting, that sort of thing. You could possibly live there long enough to outlive some of these items. So if you change the carpeting twice, since you've lived there, really you're only deducting, the last improvement that you did. So it requires good record keeping to really be able to produce that. My experience is people don't save receipts and they don't, make a record, take pictures, things like that can show the IRS, if challenged, that can show the IRS that you actually made these improvements and they were actually an improvement, not a repair.
Gotcha. And so what about home staging? If a seller puts the property on the market and they get a home staging service, would they be able to deduct that?
You know what? Unfortunately, no. Those are things that used to be available to us. They were called fixing up expenses, just kind of making the home more presentable and more saleable. Unfortunately, no, they're not. They're more along the lines of those cosmetic things like painting and nothing that could be considered an improvement. Unless you leave it behind. The furniture staging and things like that are typically temporary, so those would not count.
Gotcha. Really, it's all about organizing and making sure that you keep all of the receipts and for improvements that you've done in the past.
Yeah, it really is. I mean, I really encourage my clients to keep 3 files, during the year. So it's just a simple 3-folder filing system. You see these things on the internet from time to time, but in folder number 1, I put all my income, everything that I earn, receipts, check stubs that would, provide a paper trail for my income. And then folder number 2 is expenses and deductions. So, I mean, a lot of times, depending on the type of job that you have or if you're self-employed even, that's where I would put all my bills and statements, my mortgage statements, my property tax bills, my charitable contributions, things like that. And then in folder number 3, I put all my investment statements. So my quarterly, monthly, annual statements, just the big things, the purchase receipts. We talked about improving the house. I would put my contractor contract in there if I hired a contractor to remodel my kitchen or to replace my roof. I would put those things in there because we're not going to discard that. We're going to have to keep that for a long period of time. So I would have that 3rd folder separate from sort of my normal expenses, which are going to go away in a year. But my investments are going to be for a long time, I hope, for the long term. So, yeah, get organized, for yourself. But ultimately, that's what you'll be happy that you did if you get that nasty letter in the mail from the IRS.
Cool. Perry, I think that's all I have. I think appreciate it so much for your time. And can you share your information with me? Phone number, where to reach you, your company?
I'm in my 31st year. I have a CPA firm located in Sacramento, California. We have a 8-person firm here, so we have a variety of people with different talents and abilities. But this is kind of our sweet spot. We love helping people with their taxes and just sort of navigating what could be a very stressful time of the year, that being tax season. So they can reach us at 916-641-6990. And we're always welcome to offer advice, and if we're a good fit, would love to work with people.
Appreciate it. And yes, you've been doing my personal taxes for the last couple of years, and really appreciate the efficiency and getting everything done. And I know we've this year we knocked it out. We were done a few months before the deadline. So appreciate it so much. Cool. Thanks, Perry.
Thank you for this opportunity. If you need anything else, just call me anytime.